In today's video, we're going to talk about how you can leverage infinite banking to buy a car. Let's face it, buying a car is part of the whole American tradition, so you can be able to have that freedom that comes along with it. Think about how many times as you were growing up, like, I can't wait to get a car, I want to be able to drive and go and visit my friends and hang out. And frankly, in a large part of the US, having a car is just a pure necessity. Yet here's the thing, how we buy it, we can begin doing it differently. So let's think about how we're doing it currently and why is that costing us so much money. So I'm going to use an example here. Let's say that the average car someone buys is $20,000. And let's just say that the average person buys 10 cars at that price over the course of the lifetime. Let's say until they're age 70, they buy 10 cars. And on top of that, let's just say they're paying an average of $4,000 in interest because they're going to, let's say Bank of America, Wells Fargo, or whatever to get the financing for it. That means if they're paying that much every single time, over their lifetime, they're paying $240,000 that's going out the door to pay for those vehicles. So I want you to think about that for a moment. That's almost $250,000 that's going out the door. So why infinite banking when it comes to buying cars? This means you're going to be able to recapture a lot of those funds so they're no longer going out. So in this exact same situation, let's say that someone started buying cars using infinite banking when they're age 30 and they bought 10 cars over that period of time. Instead of having $240,000 going out, if they properly set up their bank with a policy, they could potentially have over $480,000 saved up at that point in time. So they're making money as they're buying cars. So their assets are increasing instead of decreasing with the traditional way of doing this. So how does this actually work? Why does this matter? So here's what happens. You think about when you're buying a car, you're getting the financing, and let's just kind of imagine here, like where my hand is at, is a $0 line. So when you buy a car using financing, guess what happens? You're starting off down here with those payments, you are getting back up to zero. And then guess what happens again? When you buy another car, you go right back down. That's how some people do it. On the flip side, you have people advocating, hey, just pay cash for a car. Well, that's also not the best way to do it, and here's why. So using that same connotation, like say my arm here, my hand is at zero line, and you've saved up, let's say in this case, $20,000. Guess what happens? When you pay that $20,000 to Ford or whoever else, you're down to zero, and then you're saving back up, and you're doing it again. So in either way, you're losing the ability for your money to be working for you. This is the power of infinite banking. So what happens instead is, you're borrowing from yourself, so you're never dipping down, because when you're borrowing from a policy, those funds within it never stop accruing interest. They're always generating more money. That's the beauty of it. So you think about it, that money compounding over time. So even though you're borrowing from yourself and you're paying a little bit of interest to the insurance company to borrow that money, it never stops working for you. And that's why you want to be doing it, because it's going to be more beneficial for you in the long term. So there's a couple ways that you can actually get started with it. In case, let's say you don't need a car right now, like you're perfectly fine with your existing one. Well, then we can easily get your policy set up to get started, so you're funding it, so that when you do need a car, the funds are there. That's one way to do it. Now, for some people, they might be in that situation where, like, okay, hey, you need to get a car right now, but you don't want to get an older car that you can just pay a couple $1,000s for and then build this out because you want reliability. Well, here's another way to do it. You lease a vehicle. And you may think, wait, doesn't this kind of go against the whole notion with what you want to be doing? Oh, absolutely. But, my cat decided to jump in the whole picture here and take over the broadcast. But here's what you do with leasing. You get a vehicle, and one that's going to meet your needs, and you think about the difference between the leasing cost and the cost to actually purchase it over, let's say, 5 years. So then you're leasing it, let's say for 3 years or so, And then that difference between the leasing and the actual purchase cost, you're taking that to help set up and fund your bank. So let's say that you do it for 39 months, 36 months. It just kind of depends on the lending institution with the leasing of how long those terms are set up for. But at the end of that, your goal is to maximize the funding within your policy to growing your bank, so then you're taking out a loan from yourself to pay off the balance of that lease. And then guess what you're doing? Now you're just paying yourself back over the next 2 or 3 years. So you have that car. So you might, if you're wanting to buy a car every 5 years or so, that first time you might have that initial car 5, 6 years or so. But then your bank is established and your car is paid for. So then you can be able to go off and get the next one. And this is where that power really comes in. So unless you're just going to give that car to someone else. So let's say that you have a $20,000 car that you bought the first time. And let's just say that it maintained 50% of its value. So then it's $10,000 after 5 years. Some cars will do that, some won't. But let's do that for this example. Well, then you decide to trade that in. Let's say you're able to get $10,000 from it from the dealer. Well, in that particular case, now the next time, guess what you can potentially do? You can do one of two things. You can go and get another $20,000 car, and then you're only borrowing $10,000 from yourself, so you cut your payments in half. Or you might decide, you know what? I kind of want a nicer car. So let's say you get a car that's going to cost $25,000, or let's say $30,000, or more. So let's say it's going to be a $30,000 car. Well, then that $10,000 trade-in comes in. Oh, look, your payments to yourself, they're still borrowing the same amount, are the same, and you have a nicer car. So think about that for a moment. If you started this when you were younger, that meant every time you can be getting a nicer car and a nicer one and a nicer one, and your payments are the same. That's the beauty of it. So it might think like, up front is costing me more. But we're not thinking about the short-term game here. We want to think about the long term of recapturing those dollars that would be going out. Because think about this over time. After a while, you're able to drive a really nice car, and your payment, your monthly payment, is still the same amount as when you first started and you had the more inexpensive car. That's the beauty of this, because we're thinking of the long-term game of how do we get you and your family to be in a vehicle that's going to be beneficial for your long-term and recapture those assets so you're coming out ahead financially, because the banks are going to be making money when you're borrowing from them. This way now you're making money off of your money instead of them. So to get started doing this, whether it's to purchase a car, to pay down your mortgage faster, go ahead and click the link below in the description, and we can set up a time to talk of how we can get this set up for you and your family and what's going to be the best strategy to make that work for you. So I look forward to speaking to you soon.